The world is about to wake up to a complete disaster, and serious trouble lies ahead. Ark Invest CEO Cathie Wood has spotted problems that show leading indicators. Today we will discuss why Cathie believes this recession will be twice as bad as the one in 2008. So stay tuned to your Top Tech and Trades channel. Hit the like button and subscribe. The 2008 automotive sector crisis wiped out hundreds of billions of dollars in a few months. Toyota suffered its first loss in 70 years, and Honda reported a 31.6% reduction in car sales. GM and Chrysler were bailed out by the US government, while Ford needed to get a government line of credit. Automobile manufacturers all across the world battled to keep up with a significant drop in sales. Overnight, the $2.8 trillion vehicle industry collapsed. And what if I told you that our present situation is twice as bad? One of the most dependable studies in the financial business is the University of Michigan Consumer Sentiment Survey. The following question is one of the most important aspects of the survey. Speaking of the automobile market, do you think the next 12 months or so will be a good time or a bad time to buy a new vehicle, such as a car, pickup, van, or sport utility vehicle? This question has been asked since 1961, and as you can see from the graph, the percentage of people who believe now is a bad time to buy a car has reached new highs. This level of negative consumer sentiment is the highest that it has ever been in the history of the survey. The rising automobile prices are all due to lack of supply rather than a lack of demand. Dealer inventories have dropped to record lows, and that is causing prices to increase drastically. Just like the level of inventories, the consumer demand for vehicles is at an all-time low. Automakers are rapidly attempting to order new semiconductors for their vehicles, but the consumer demand likely won't be there by the time the chips arrive. The automobile industry is rapidly transitioning to electric vehicles, which is putting people on the fence about new advances. Add to that fact that automobile prices continue to rise year after year. In addition, the motor sector is in grave jeopardy. Consumer confidence has been harmed by an increase of $11,000 in the average new car price over the last 3 years. High prices, according to the University of Michigan, are the cause of low consumer sentiment. That demonstrates that car prices are not sustainable at the current price level. The Manheim Used Vehicle Value Index perfectly demonstrates the decelerating growth of car prices. Everyone knows that the exponential price increase in the auto industry can't be sustained. There's a massive price bubble, and the supply is starting to catch up as supply increases disproportionately to decreasing demand. Automakers and dealerships worldwide could be left in a glut. A glut is when there is an oversupply of a good. That leads to a massive crash in prices. Elon Musk, Lisa Su, and GM have all been saying that chip supply constraints are starting to dissipate. Everything that I just described is what Ark Invest has been focusing on, particularly analyst Sam Corris. Automobile sales are already showing signs of a rebound from the chip shortage. In January 2022, total car sales reached 15.5 million units, an increase of nearly 20% over the previous month. That is clearly a significant increase, and it is likely to satisfy the remaining consumer demand caused by the supply constraint. Once the market for higher-priced vehicles has been met, problems with urgent demand are likely to arise. All of these reasons, Cathie says, are combining to cause the largest price drop in the history of the automobile business.
In the survey, deeply buried in the survey, there's a part that says, or asks the consumer, is now a good time to buy a car? And I hadn't looked at this statistic in quite some time, but it has dropped to a new low, 46. It is lower than the low in 08-09, which was roughly 100. And pre-COVID, it was running at 150. So it's about a third of that. And it just dropped to a new low. Now, this flies in the face of what we saw in January, auto sales moving up quite strongly from 12.4 million units in December to 15 million in January. And what we believe has happened there is the various automakers had been building up inventories at the factories or near the factories, just waiting to put in chips, as we heard all about the chip shortage during the last year. And so they are now saying that chip shortage is alleviating. So there have been people waiting for their orders to be delivered. But if this survey is right, there's not going to be much follow through.
The looming car industry crisis isn't just about vehicles. It's about products in general. The total amount of inventory held by businesses is beginning to rise considerably. The inventory to sales ratio grew to 1.29 in December 2021, up 3.2% from the previous month. A 3.2% rise may not seem like much, but when annualized, it amounts to a 38% gain. This quick increase indicates that new supply plants are ramping up. AMD CEO Lisa Su already stated this at a conference. Many businesses have invested in new supply plants as a result of supply constraints, according to Lisa Su. The problem is that those supply plants don't go into production immediately. The average supply plant takes roughly 18 to 24 months to go into production. Most businesses invested in supply plants in late 2020, which puts the time frame for a supply rebound in early to late 2022. Cathie has been predicting a crash in goods prices for a while, but her thesis hasn't played out yet. This has caused Ark Invest's ETFs to decline substantially. However, if she's correct about the coming trends, then the world is about to be shocked in a considerable manner. There were two secular trends for inflation. The first one is disruptive innovation competing with traditional companies, which forces prices to be lowered due to higher competition. One instance of this is in the auto industry. Gas-powered vehicles have to compete with electric or hybrid vehicles. This new and growing competition means that gas vehicle prices will have to be lowered in order to compete. The second trend is the fact that improving technology allows for lower prices due to production efficiency. If we go back to the auto sample that we talk about, EVs are the perfect manifestation of lowering prices. Battery prices are declining year after year, which is allowing EVs to be more accessible to the public. Because consumers may buy items at cheaper prices, this form of innovation is essentially deflationary. The other inflationary trend is cyclical, as evidenced by the prior discussion of rising inventories. Cathie just appeared on CNBC to discuss her inflation forecast. The core to her argument is that she believes inflation is driven by supply rather than demand.
The supply chain issues have lasted so much longer than we anticipated that they would take a while to work out, but not 2 years. So the question is this supply chain related? And will these inflation metrics unwind? I think a lot of what's going on is supply chain related. I know it's become unfashionable to use the word transitory, and so we won't because it's lasted longer than we expected. However, I do think there's going to that the deflationary forces that are building up in the economy today are pretty strong. Two are secular, one is cyclical. And the bond market is sort of getting this. If you look at what's happened to the yield curve, so the difference between long rates and short rates, it has flattened from, I think, 155 basis points last March to 45 basis points today. And if the Fed did go 50 basis points in March, which they might, I think that it would be one and done then, we'll end up with an inverted yield curve. And then what are people going to think? Well, an inverted yield curve and the flattening yield curve says, watch out. Something's going on here. Either growth is going to disappoint or inflation is going to be much lower than expected, or both. And we think both is right. And so that's the cyclical source. There's an inventory buildup. If you look at the record-breaking inventory buildup in the fourth quarter GDP report, you'll get a sense, while inventory to sales ratios might be low, as the consumer switches off here. And if you look at the last 3 months of either retail sales or consumption, the consumer has gone pretty flat. Meanwhile, you've got the double ordering and triple ordering by manufacturers and wholesalers because they were missing sales before. So I think there's a big inventory problem brewing here. It's going to hit within the next 6 months in terms of that recognition.
The automobile sector exemplifies the economy as a whole. For the past year, inventories have been unusually low, causing prices to rise. In the last year, new vehicle prices have risen by more than 12%, which we all know isn't sustainable. This is similar to the growing consumer prices in the overall economy, which have been increasing at concerned rates. The key point with this macroeconomic situation is that the consumer demand is lower than it has ever been. Just like the chip shortage in the auto industry, overall inventories in the global economy are starting to rebound. Once the new supply plans enter the economy, that will be the ultimate shocker of 2022. That will lead to a critical economic slowdown. During the 2008 recession, our pricing dropped by around 20%, which was a huge amount at the time. Given the tremendous price increase in used automobile pricing, we might easily see a 60% or even 70% drop in price to return to former levels. The car industry's bubble is poised to collapse as the supply shortage is expected to ease soon. Now, what do you think? Comment down below, hit the like button and subscribe. This is your Top Tech and Trades channel. See you in the next video.